Welcome to This Explainer. Today, we're going to unpack the mechanics of a company sitting quite literally at the bedrock of our digital future. We are talking about Ultra Clean Holdings, or UCT. We're going to dive into exactly how they're navigating this absolute massive AI boom we're seeing, how they're restructuring their finances to capture the upside, and how they're proactively preparing their global footprint for long-term climate risks. It's a really fascinating look at the anatomy of a true tech enabler. Right, let's just jump straight into the massive industry catalyst here. According to UCT's CEO, James Shao, hyperscalers and cloud providers are expected to drop around $600 billion into AI infrastructure this year alone. Just think about that number for a second. $600 billion. That tidal wave of capital requires actual physical hardware, the picks and shovels of the semiconductor world, if you will, to become a reality. So, to truly grasp how UCTT is capturing that market, we've got a clear roadmap for today. First, we'll look at the AI infrastructure boom. Second, we'll break down their Q1 2026 financial highlights. Third, we're going to look under the hood and analyze their balance sheet. And finally, we'll cover how they're future-proofing against climate risks. All right, Section 1, the AI infrastructure boom, and specifically, scaling wafer fab equipment. This right here brilliantly illustrates the sheer scale of the opportunity in front of them. The projected global wafer fab equipment spend, or WFE for short, is projected by customers to land between $140 and $145 billion in 2026. That is an incredible 18 to 20% year-over-year growth. Because as these semiconductor fabs scale up to meet insatiable AI demand, they literally have to buy the core manufacturing equipment that UCTT helps build and service. Now, what's really interesting here is how UCTT is positioning its physical brick-and-mortar capacity to handle this. Right now, they're running at about a $2.2 billion run rate, but their current infrastructure is already primed to support $3 billion. And listen to this, with just some modest, rapid capital investment that they can deploy in, say, 6 to 9 months, they can scale to support up to $4 billion in annual revenue. They are making absolutely sure they don't become a bottleneck for their rapidly expanding customers. Moving right along to Section 2, Q1 2026 financial highlights and how they're capturing this upside. Looking at this comparison between Q4 and Q1, you can clearly see sequential growth across the board. Revenue bumped up to roughly $534 million. But more importantly, as those revenues grew, their profitability scaled right along with it. Gross margins ticked up to 16.5%, and operating margins expanded as well. This just shows really solid operational execution. As they push higher volumes through their facilities, they're getting a better product mix and seriously improving their bottom line. So, the crucial takeaway here is understanding their revenue mix. The vast majority of their income, almost $466 million, comes from products, things like modules, components, and gas delivery systems. But you definitely shouldn't ignore that $68 million slice. That's their services business. It boasts a very healthy 30% gross margin, and management actually expects this highly profitable segment to consistently make up about 10 to 12% of total revenue as global fab capacity ramps up. Okay, let's jump into Section 3, analyzing the balance sheet and those strategic mechanics, because a company with great sales still needs masterclass cash management. Now, this might catch your eye, and honestly, it might seem a little alarming at first glance. In Q1, UCCT posted a positive net income of $14.5 million, but their operating cash flow was actually negative $33.3 million. So wait, positive income but negative cash flow? Red flag, right? Actually, scratch that. It's not a red flag at all once you look under the hood. It perfectly captures a deliberate, aggressive operational strategy. What we're seeing here is strategic inventory accumulation. They are intentionally pulling cash out of the bank and investing it into inventory right now. In fact, they've had over $107 million in inventory changes over the trailing 12 months alone. Why? Well, in an environment where hyperscalers are absolutely racing to build AI data centers, the equipment supplier who can deliver exactly on time wins the game. UCT is tying up cash so they are fully armed with safety stock and ready the second the market demands immediate deliveries. Of course, to fund that kind of aggressive inventory build, having cheap capital is absolutely essential. And check out this brilliant financial maneuvering. In Q1, they drastically slashed their weighted average cost of capital from roughly 6.2% all the way down to a projected 1.4%. That is a massive reduction that frees up a ton of corporate resources. So, how did they pull that off? By pricing $600 million in zero-coupon convertible notes. They essentially swapped out their expensive debt for much, much cheaper financing. They took that new money, completely paid off their pricey Term Loan B, and practically erased $30 million in annual interest expense. On top of all that, they upsized their revolving credit facility to $250 million and pushed their maturities way out to 2031. It is literally a textbook example of fortifying a balance sheet to ensure incredible liquidity for the next 5 years. Finally, let's zoom out to Section 4, future-proofing climate risks and looking at the 2050 horizon.
Because honestly, building all this scaling infrastructure doesn't mean much if it's vulnerable to physical threats. And they aren't leaving this to chance. In 2025, they brought in a specialist climate consultancy to perform a rigorous TCFD assessment. That's the Task Force on Climate-Related Financial Disclosures. They evaluated 13 potential climate hazards and stress-tested them across their entire footprint, 25 distinct manufacturing sites and 9 corporate offices all around the globe.
Out of those 13 hazards they tested, these 8 specific physical risks right here were identified as high-priority threats to their operations. We are talking about very tangible, real-world risks like coastal flooding, wildfires, and water scarcity. These are things that could genuinely disrupt their global workforce, their logistics, and their physical assets if they aren't properly planned for. To mitigate those long-term threats, UCTT has committed to science-based targets. As this chart maps out, they are specifically targeting a massive 90% reduction in Scope 1, 2, and 3 greenhouse gas emissions by the year 2050. It's a very aggressive road to a fully net zero value chain. And the great thing is, they aren't just making promises for some decades away and kicking the can down the road. They've set strict near-term accountability targets too. They plan to drop their direct operational Scope 1 and 2 emissions by 20% by the year 2030. So let's bring this all together. We're looking at a company riding explosive AI-driven growth in semiconductor equipment, paired with just masterclass financial engineering to free up cash, all while proactively stress-testing their physical footprint against real-world climate change. It really leaves us with one compelling question to ponder. With their capacity primed and their borrowing costs slashed, is UCTT perfectly positioned to be the unseen engine dominating this AI supercycle? Thank you so much for joining me for this explainer, and I'll catch you in the next one.